Hello everybody. Our group topic is the comparison between three-factor Fama French model and five-factor Fama French model for the China's liquor stock market. And we will introduce our topic in the five following parts: the background, data selection and factor construction, time series characteristics, regression details, and result overview. The first part is background. From this page, we can see from 2015 to 2019, the CSI liquor rose over 250%, and the CSI 300 rose only about 20%. That is to say, if you invest in the CSI liquor stock, you will get a much higher return. And this trend maintains the same this year. We can see the increased rate of CSI liquor is over 4 times that of the CSI 300. So the CSI liquor is the hottest stock index in the China stock market. This is why we choose it as our research object.
About the data selection, we download the data of liquor index from the 2015 to 2019. First, this index includes 80 stocks such as Maotai and Wuliangye. Third, indicators of factors including each stock's BP, liquid market value, ROE cut, and the asset change rate. About the first model, FF3, the first factor it needs is the market factor. It equals to the daily return of the market index to minus the risk-free interest rate. The second factor is SMB. It equals to the small market value group to minus the big market value groups. The last factor we need is the HML factor. It equals to the high BP group stocks to minus the no BP group stocks. FF5 model need two more factors. The first is the CMA factor. It equals to the weak asset change rate groups to minus the robust asset change groups. The next factor is the RMW factor. It equals to the aggressive ROE cut groups to minus the conservative ROE cut groups.
Firstly, we do summary statistics for these average factor returns. In these two models, average HML return is the largest and the average returns of the other three factors are all negative. The T statistics for average HML, RMW, CMA market factor, and SMB returns are smaller than 1.96, which means that the null hypothesis of the mean equals to 0 cannot be rejected. Then we use the first day of accounting as a benchmark and calculate the cumulative net value curve. According to the curve, SMB was stable around 1%. There was a rapid rise around June 2015 of market factor, which reflects the ups and downs of the entire market. HML, RMW, and CMA fluctuated between 0.96% and 1.02%. Then we do the correlations between different factors. We can see that the correlations between the factors in these two models are low, so we can assume that there is no collinearity between different factors. Here are the bar charts of the average return of this portfolio. The average return of the high BP is larger than that of the low BP. The average return of the strong profitability is larger than that of the weak profitability. When the investment increases, portfolio of big stocks have higher average return, while small stocks have lower returns. This can prove that the company's total asset can be regarded as future amortization expense, which is a kind of cost. The average return increased from small stocks to big stocks. Then we do the GRS test. GRS test is a way to test whether alpha is equal to 0 jointly. As for the larger GRS statistics, it means that the value of the intercept term is not equal to 0, and the model cannot explain the fluctuation of the return very well. From the figure, the GRS of FF3 of size BP and size investment is smaller than the GRS of FF5, and the p-value is larger, indicating that the 3-factor model is better than the 5-factor model.
After GIS test, we do regressions for 6 value weight portfolios of FF3 and FF5 respectively. The results are shown in the tables. We can see that for 5-factor model, the alpha, which are the intercepts of the regressions, do not perform better than 3-factor model. Especially in size ROE portfolios, most of t-values are larger than 2, which means we can reject non-hypothesis that the alpha is equal to 0. And that indicates the 5 factors cannot fully explain excess return. Besides, for the coefficients of IMW and CMA, the t-values are not very large. That means 5-factor does not have a views advantage. Combined with the GIS test above, we may conclude that 3-factor model is better. Thus, we conduct attribution analysis on 3-factor model. From the table, we can see that this model can make good explanation for excess return. Most of the alpha are equal to 0 significantly, as most of t-values are less than 2. And the market factor is the most relevant factor with stock returns, as the t-values of coefficients are very large, and the beta values are around 0.7 to 0.9. For size factor SMB, the coefficients of small size portfolios are positive, while the big size are negative. That means when yield of small stocks are more than large stocks, the small size portfolios will gain higher rate of return, while the big size will gain negative influence. For valuation factor HML, beta from left to right has a monotonous increasing trend. That means the higher book-to-market ratio portfolio has, the more it inclined to have positive correlation with valuation factor. Besides, we can find that for portfolios with small size and middle book-to-market ratio, the explanations of size factor and the valuation factor are not strong, as t-values of their coefficients are not large enough. In other words, it means the excess return of this kind of portfolio mainly correlated with market factor. Generally speaking, market factor is the most relevant factor, and the effect of SMB is obvious enough. For HML, also it does not have really powerful influence, it's also an important factor.
The final part will be the results overview. From previous analysis, we can summarize 3 results. The first one is 3-factor model is more applicable to liquor industry than 5-factor model in China's security market, and the profit risk factor is redundant from the empirical analysis. Companies in the liquor industry generally keep high net profit rate, so that the profit factor cannot well explain the change of the return rates of stocks in this sector. And the second one is the market factor is the most relevant factor of all. Its beta value is basically around 0.7 to 0.9, which means the degree of change in this sector return is slightly less than the change of the overall market return. Investors should pay attention to the macroeconomic environment when they invest. And the last one is, it can be seen that the small-scale effect of the liquor industry is not obvious, which believes that the smaller the company scale is, the higher its return. On the contrary, the polarization is more obvious, and the liquor industry may have the Matthew effect. Large-scale, high-quality companies with outstanding brands have developed faster and have better performance, while the development of small-scale companies is not satisfactory. So large-scale stocks with brand advantages may be a more rational investment decision. That is all of our presentation. Thank you.